Welcome back, sprinters. There is a $42 billion opportunity in front of us. The data center market is right now around 20 billion, and it will be soon in 2030 at around $42 billion. How can you benefit from that? What are the best 6 companies we can invest in the data center and not gambling about single shots like Nvidia, but looking at the picks and shovels? What will the data centers need to succeed? I've looked at a few things. The first one is electricity. They will need electricity, and there will be a shortage of it. If you think of it, I can wait for 3 years, 5 years for a utility, for my government to help me. Companies like Google say, I'm not waiting for the government. I built my own reactor. But that takes 3 to 5 years. Smaller companies don't have the time, don't have the budget. They will go for distributed system. Is there a small gas turbine that somebody can bring? Can you install it in 11 days, 20 days? So one thing I've been looking at is who will secure the electricity for the data center, because they will need power. And the second one was, what if on the other side, I can make them more efficient? So basically reducing power. Who will help data centers reduce the amount of electricity needed in the first place by making them more efficient? We found 6 companies. One of them is already in our portfolio. The other 5 are not. Let's do this, guys. Are you ready? Let me share our findings. I've been digging the best 6 data center companies, and this is what I found. Funny is, I was running and I was talking back and forth to Claude and to Gemini to get this started, and it's amazing how easy it is already to do it on your phone while you're running. And then on my desk, I had a lot of research already ready. I just had it to refine it and to put it together properly. So these are the best 6 companies. And when we say best, what are the criteria? You know that we require excellent ROIC profile. We look at the return on invested capital, and we look at the return on incrementally invested capital. So one is backwards, one is forwards. If I put $1 in, can they make $1.3 out of it, or more or less? Because this is needed for long-term compounding versus, the quarter-to-quarter gambling that we are not interested in. So long-term compounders need a high ROIC. They need some growth, obviously. We want them to be growing above 15% in revenue. And then we'll look at the compound annual growth rate that we can expect from here. What's the CAGR from here? So the situation is pretty known and pretty clear, right? We will have 42 billion in 2030 at a 13% CAGR. The AI racks, they require 3 to 4 times more power than traditional servers. And also they require some new expertise because it's all new for most clients. And now new services can come in, and it's not just the product, but it's also the expertise around that we have to look at. So the first winner here is Arista Networks. It's the AI networking champion. If you look at its ROIC profile, the ROIC profile of Arista is industry leading. You have a 54% ROIC, which is not just high. I mean, it's very, very high. You cut it in half, it's still very high, but it's endurable high. So they have shown this over many, many years. We want at least 5 years. They They have shown this over more than 5 years. So there is consistency. The gross margins are high, 65%, incredibly high gross margin. And they're also innovating because the switches now will be capable of doing many more things to connect even more things. Think of IoT, the connected world and connected data inside of the racks. Now, the 5-year CAGR potential is 18 to 25. It's not the highest of those six, but it's still the winner. So, Simon, why it's the winner? If you later on you will see a 30 and 35% CAGR, because we always go for quality first and then CAGR second. So if you can have a high CAGR, this is very high CAGR, guys, 18 to 22%. If you can keep this up for 5 years, that's stellar returns. We're talking here the top 1% of the companies on this planet. So 80% of the revenue is exposure to data center markets. So it's not a pure play, but it's kind of. And the enterprise campus market expansion from 41 billion to 70 billion by 2028 provides additional growth vectors beyond just the hyperscalers. And of course, they are full of optionality. I trust management. I've been watching them, talking to them for many years now. I really trust Arista, and I own Arista both in my private portfolio and in our publicly traded fund. If you don't know our fund, it's called Steady Compounders, and it has 10 companies in there. The fourth biggest position is Arista Networks, which is already up 40% since we bought them a few months ago. So strong company, and we own it. The investment quality is absolutely high, and the competitive mode is very high because the switching costs are literally the cost of changing the switches, since they have both hardware and software. You are not just switching the switches, switching the hardware. You have all your workflows that you had on your software. You have to retrain people on how they work. When you change the software, you have to retrain them and transpose those workflows on a new software. So some of their clients are Meta and Microsoft, which in the beginning made me pause a bit because they made already like 20% cluster risk. You don't want to have 20% of your revenues with one client alone. So in the beginning, I was hesitant, but then the more I studied Arista Networks, the more my hesitation went away. Second place here, silver medal goes to Astera Labs. This is a company that I've just beginning researching a few months ago, so I don't have a position yet, but I would love one actually, and I'm researching it over the next days and weeks, continuing to research. ROIC profile is very low. That's why they didn't make the cut in the first place. But if you look deeper, we have 75% gross margins. We have a CAGR potential of around 30%, which is incredible. And they are 100% exposed to data centers. We will see it also later with Vertiv. They are more exposed to data centers than NVIDIA is. So this is a very high exposure, pure play AI data center play, if you want, with all the pros and cons. Pros, it can grow very fast. Cons, if, like the bears say, this is a 2 years boom and bust cycle, then in 2 years you have the other side of the equation. Net cash position of 1 billion provides flexibility, and overall very strong cash flow, strong strategic position, deeply integrated with NVIDIA and AMD. So this is an emerging winner. Now, if you're a growth investor, this is your thing. Since we are a quality investor first and growth second, I'm still analyzing this one, but it made the cut. It made the cut to number 2. Now, number 3, this is the company where I say they're more exposed to data centers than even NVIDIA, and it's even true. Vertiv has a mixed history. had some terrible years, but now the ROIC profile is back above 15%, so it's back on our watch list. It's extremely efficient and profitable. It can grow another 15 to 20% year over year over the next 5 years, so it's incredible. It has 80% revenue exposure to data center markets and 23% to cooling. So these data centers, they get really hot and you have to cool them. You can cool them with air, which is not very efficient. And you remember our question was, who can help me, the data center, be more efficient so I need less electricity in the first place? That's what liquid cooling does. Liquid cooling, it's not just water, it's a specific way of liquid cooling those racks so that they don't overheat and they stay efficient and you need less electricity in the first place. So growing fast, it has a dominant position in cooling with advanced liquid cooling solutions that are essential for high density AI computing. And this is the number 3. Now, we would never go with number 4 and number 5 and number 6, but for good measure, let me tell you that GE Vernova is number 4. Great potential. There is another fund. So this is our fund, the Steady Compounders, but there is another fund that I really find interesting. It's called the Granny Shots by Tom Lee from Fundstrat. And he's a very smart guy, and he's been very right recently on many things. So in his fund, he recently sold FICO, which we bought. So we have different opinions on that. But then also he owns GE Vernova, he owns Arista, and he owns Caterpillar, which you will see in a second. So this is the Fundstrat Granny Shots ETF. This is our Steady Compounders ETF. There are some overlaps and some differences. We've been recently buying FICO, they've been selling FICO. But we agree on Arista Networks. And they are into GE Vernova. GE Vernova is the spin-off of General Electric, which is a high-quality company in the first place, turned around, split off, now has great management, has great potential, is growing fast, has long-term contracts, not as high a ROIC profile, so it does not make the cut for our portfolio, but it was good enough for Tom Lee, so it's a good company, right? We just expect more as the minimum threshold, but we expect a lot because we want reliable, steady compounding. So the 5-year CAGR, 12 to 15, very high. Why not? Net cash position of 6 billion, 2.7 billion in free cash flow. I think it can be a winner. And then Caterpillar. Did you know that Caterpillar was, during the oil crisis, was one of those companies, together with GE and together with Siemens, that actually brought these small modular gas turbines because energy and electricity was needed much faster. Number 6, one of the best companies on the planet, Linde, with a great management, great track record, excellent financial management, but cannot make the cut because they will just grow 6 to 8% CAGR. That's not good enough. If you risk your money, then you have to expect much higher CAGRs. And so while Linde is an extremely high quality company, it will not give back to shareholders enough for us to recommend it. This was the 6 best data centers plays. As always, you can get the whole article on The Investing Show. It's theinvestingshow.beehive.com. I share every few days parts of my research, and I share for paid members also my whole portfolio and the real-time moves. You will find a lot of companies in here. The most recent ones have been the 6 data centers, WiseTech, JP Morgan, Tokyo Electron, Amphenol, and many, many more. So I hope you have a great day, guys. Keep rolling, everyone. If you're looking for the ETF, it's called Steady Compounders on wikifolio.com. Keep rolling, everyone.